Good afternoon, everybody. My name is Andrew Dix, and I'm the founder of the Crowded Media Group. We're the publishers of Crowdfund, and we cover all things fintech, including online capital formation. And today we have a super interesting discussion with a panel of experts on regulation crowdfunding, or Reg CF, as I call it. This is the smallest exemption that allows early stage companies to raise money online. And we have three people here that know it inside and out. They know it far better than I do. We also have one of the OGs from the early crowdfunding days, Woodie, Neiss, who just has a lot of stories to tell. He's going to tell some of them today and perhaps more in the future. But beyond Woodie from Crowdfund Capital Advisors, we have Matt Goldstein from DealMaker, and we have Etan Butler from Dalmore. So we'll start with you, Woodie. Just do your introduction, and then we'll go counterclockwise and have everybody say who.
Okay. Woodie Neiss with Crowdfund Capital Advisors. One of the three entrepreneurs that wrote the framework for investment crowdfunding, which became the basis for the bill that went in front of Congress. There were many people that were involved in this. There was a petition before we even got started. We were just the ones that showed up in Washington, walked the halls of Congress. We testified in front of 5 U.S. House Senate panel hearings. We went back and forth with the bill. Little stories along the way. The bill was stalled in the Senate because there were 3 competing bills. We took the 3 of them and came up with a common sense compromise after I asked my father what we should do. He's like, I don't know, just write the compromise and hand it to everyone and say that's the bill. And that was the final version of what came into the Jobs Act. We were excited to go to the White House on April or March before it was, or April 12th when it was signed into law. It's been, really exciting to see the industry grow. Our main thing that we've been doing is consulting and advisory. Wrote that little book up there, Crowdfund Investing for Dummies. Worked with the World Bank, wrote the crowdfunding's potential for the developing world for them. The State Department hired us to fly around the world and talk about crowdfunding because apparently it's cheaper to promote businesses and jobs than give out money to countries to get people off the street. So that's been an exciting part of what we've been doing. And most recently, I became a co-founder and CEO of a company called Guard. We do disclosures for private companies that really want to facilitate the secondary transfer of these securities. So in Reg CF, we enabled the primary issuance of these securities. Now we actually have the ability for secondary transfer. Not all securities, of course, are going to have a market. But where there is a market now, we've got these alternative trading systems in place, and Guard is a technology platform that sort of handles the compliance on the state level for these securities so they can trade to both retail and accredited investors.
Awesome. So I'd like to interject there. There's a success has many fathers, failures an orphan. Everybody always says that Woodie is really, he was there before the beginning. So he is truly an OG. So let's jump over to you, Etan.
Hi, Etan Butler here. I'm the chairman at Dalmore Group. We are a FINRA registered broker-dealer investment bank headquartered in New York, and we were founded in 2005. We spent the first 10 years or so focused primarily on institutional investment banking and corporate advisory services for private and public companies in multiple sectors. And since Woodie's good work in 2012, at that time we made a shift to helping companies raise capital primarily online through Regulation A, Regulation D, and most recently Regulation CF. I think we're most well known for our involvement in Regulation A over the last number of years. We've onboarded over 240 Regulation A clients, including a number of the more successful Reg A offerings that have been done, and have facilitated over 1 million Regulation A investments just since 2019, and over 100,000 secondary trades, Reg A secondary trades over the last year and a half. And we've observed what's been working well and what hasn't in this young and a quickly evolving industry. of crowdfunding. And we've become a lot more active on Regulation CF, over the last few years since the increase from 1.07 to 5 million. And many of our issuers are choosing to go down the Reg CF path as a result of that prior to launching a Reg A. So it's become a lot more relevant as far as Dalmore's concerned.
Awesome. Thank you, Etan. Matt.
Hi, everybody. My name is Matt Goldstein. I'm one of the co-founders of DealMaker. DealMaker is, at its core, a technology company. We started as a platform providing solutions to issuers who are raising capital online. And we've been a leader in transforming the raising of capital as an activity into a form of e-commerce. So using our platform, issuers can license an online store and they can run a full end-to-end e-commerce campaign aimed at growing their brand and turning a community into a shareholder base. We know companies out there have been building relationships with stakeholders in the form of having customers buy their product, having fans support their team, having stakeholders follow their newsletter or Instagram. We've given those companies the ability to turn those communities into a source of capital. We specialize in the online capital formation exemptions known as Regulation A, Reg CF, crowdfunding. We do a lot of 506C, which is under Reg D as well. We've had the privilege of hosting the largest online capital formation offerings on the planet. We did the Green Bay Packers common stock offering back in November, which wasn't under Reg CF, but I bring it up because I think it's a shining example of the opportunity on both sides for companies to turn their communities into a source of capital, and for communities who love a brand and feel connected to it to become owners in some way that's meaningful to them. And for me, Regulation CF, which will be the topic of today's conversation, really exists. And maybe Woody, we can talk about that a little bit more, kind of how it came into being, but it really exists to fulfill that opportunity to bring people closer together, companies on the one side and their stakeholders on the other side, even in small amounts using credit card buying online. We see a major trend in capital formation globally towards a retail base of shareholder purchasing. And we think the internet will change the capital markets forever in terms of how companies can raise capital. So I started my career as a lawyer, as a partner at an international law firm called Dentons. I'm called to practice in New York as well as in Canada. And we do a lot of global offerings because in our view, communities today are global, and regulators have created national boundaries between different jurisdictions, but capital doesn't feel constrained by boundaries, and communities don't feel constrained by boundaries. So our mission is to bring people closer together using technology.
Awesome. Thank you, Matt. So Reg CF, in brief, as we've already mentioned, was created under the Jobs Act of 2012. While it was signed into law that year with broad bipartisan support, it took the Securities and Exchange Commission a little bit of time to actually create the rules, which should not be surprising to people who understand how our bureaucracy and government works. It actually became actionable in 2016. So that's really when the exemption became available for companies to raise capital online. Last year, a material improvement took place. The SEC decided to raise the funding cap from $1.07 million, which in my opinion was pretty anemic, to $5 million. And this has had an absolutely great impact on not only the industry, but also for companies looking for an early stage funding round, as well as for investors, because now you have a broader universe of maybe a little bit more mature firms looking to raise capital under the exemption. So since Woody is here, and he is an expert also in data, because that's part of what he does, I've asked him to kind of provide an update on kind of where things stand today. And these are the most recent numbers. You can't get them anywhere else except from Woody. So Woody, maybe you can dive in and share your insight and wisdom with us.
Sure thing. Just as a backstory, when we left the White House, Bloomberg had us on television to interview us about this new form of access to capital, what it means. And then after the interview, they asked us, what role we were going to play in the industry. And Jason, Zach, and I sort of looked at each other and we're like, well, we don't want to be a funding platform, so don't really know. But I have a background in Silicon Valley and databases and all that stuff. And they said, with that background, if you build a database and you collect the data on all these companies raising money online, you can port that through to us. And at some point, institutions and other financial service firms are going to be interested in this. And when it gets to that size, that's going to be of importance. So I built that database and in 2018 started porting that data over to Bloomberg. So the data that I'm going to present to you is data that is on Bloomberg's terminal. It's available to anyone that has a terminal with the goal of at some point, we will have much more institutional eyes, ears, and dollars focused on this industry. So with that, like Andrew was saying, it started in 2016. We're at 2022. I took a snapshot as of yesterday to see what was going on. We've had about 3,500 pre-IPO startups and small businesses across the United States raise about $1.5 billion through 4,100 offerings. So you can see that there's been many companies in there that have used this framework to actually do multiple rounds of financing. I think that's great because, as we were just talking, you can go to your communities and raise money, but you can also build wealth for your communities. So these companies that are actually going back for multiple rounds are usually doing it at a higher valuation. And if you actually just look at the economic value that's been created in companies that have been successful with their funding rounds, it's up to $42.5 billion. Now that's sort of stored right now, $42.5 billion. But at some point, there's going to be liquidity for these companies along the way. And those investors that got in early are going to be the ones that have the greatest benefit. So I'm excited because I feel like we're at this tipping point in the industry now where we're going to start to see the acquisitions, the mergers, hopefully an IPO of one of these companies. And the beauty about it is these companies are getting funded all across the United States. We do research on this to see, the impact that this is having. It's in all 50 states, the Virgin Islands, Puerto Rico, over 1,500 cities have been represented. The success rate of these offerings is 69%. So if you look at, do I want to raise money for my business? Where am I going to go? Well, you can go to a bank, but they're not going to lend to you if you're less than 3 years old. Do you have venture capital in your area? Most people say, can't say yes, or they don't have connectivity to that capital. So this provides a means for them to actually get that capital. Even if you did, by the way, have capital, you'd probably get about a 2% chance of success with that. The thing that really makes this unique and powerful that Matt was talking about before is how you turn your customers into investors and you engage this community of people in your business. There's been over 1.5 million investors, and these are retail investors all across the United States. So it's not the rich investing in companies. It's the average American saying, you know what, listen, I use this product or service, your company in my backyard. I've seen you do what you do. Actually, I'd love to become an investor in it. That's 1.5 million Americans getting into these businesses. This is happening on right now about 70 active online investment platforms. I tell you about the majority, over 90% of the volumes taking place on like the top 5 platforms in the industry. Average investment's about $1,000 per investor right now. You've got those that are investing, $20,000, $50,000, but the average retail American can't invest that much. They're putting about $1,000 in. Some of the biggest beneficiaries of this are women and minorities. It's been fascinating in the research that we've done for companies that have hired us to particularly research. Can you tell us the impact that this has had on women and minority entrepreneurs? When we do the research on the offerings where they've been successful, one of the questions we ask them is, why did you go here? And they're like, well, no one else is funding me. It's impossible for me to get venture capital funding because they don't invest in women and minorities, even though they talk about, how that's changing. And so they're like, this is my first choice. I've talked to other women and minorities that have gone this route. And so this is my first choice for funding. And it's not that you have to be in any particular industry to do this. When we got started with this, I thought, okay, I could see the Main Street retail type of businesses really having an impact with this, and software applications, sort of technology. But what we're seeing in the data is there's been over 500 industries that have been funded, which blows my mind. Because you usually think, if it's aerospace or something, your investors really need to understand aerospace. And so, well, that just means that people that understand aerospace are investing in these businesses. So there's a demand of capital among these businesses, and there's a supply of risk capital from this broad range of retail and accredited investors all across the country. And I'll just end with two really powerful points. One is this was part of the Jobs Act, okay? We went to Washington, D.C. At the time, they were buying jobs. We were selling jobs with this legislation. How have we done? Well, if you look at the companies that have both started, scaled, hired, supported employees in and around their businesses, it's about 300,000 jobs that have either been created or supported directly as a part of this legislation. I think that's so powerful in the sense that we've accomplished what we said we're going to do. And the last thing that I think is as equally as important as any of this stuff is these businesses spend money, okay? It's not only that you're investing in a business so that you can have the potential for a return down the road, it's that these businesses, they hire employees, they buy products and services. Mainly they buy products and services and employees from the people that are directly located in their community. So why is that so important? Well, that number we think is about $3.4 billion that's been pumped into local economies. Now, what's happening with the public markets right now? We've got this volatility. We've got these, we got this war in Ukraine. We've got, inflation that we're trying to get under control. If all of that's causing the public markets to pull back and have high volatility, there's no way that startups and small businesses are going to get capital. And they're going to need to get it from people in their own communities. Well, if we have this recession and we go into this recession, it's going to be incredibly important that we support these local businesses, because that $3.4 billion is money that's staying in these local communities. It's not, of course it helps our national GDP, but the point is if we go into recession, we're going to need to do everything in our power to help support businesses at a local level to sustain these local economies.
I think that we already are in a recession, at least technically. So I agree with you. I think everybody here will agree with you, and I think Matt and Etan, you both are seeing some of that right now. I want to jump over to Matt quickly because Woodie, you talked about types of companies using this, and I always thought, okay, these are kind of the smallest firms. And I think what is that 1.07 million? It really was a startup or local thing. But I think with that transition to 5 million, we're seeing a broadening of companies that are utilizing this exemption. So, Matt, I'm going to ask you first. What are you seeing, live and in the wild in the world?
Yeah, so I think over the course of time, with each passing quarter and with each passing year, the understanding about turning a community into a source of capital and using the internet to originate capital formation becomes more and more mainstream. In the very, very beginning, we can go back to the earliest days that Woodie was describing, and this is true of a lot of innovation. Maybe it starts on the margin. It starts with people who are blocked from traditional pathways. It starts with people who are, looking to technology to go around an obstacle in the kind of mainstream markets. But over time, when people understand the power of crowdfunding, they realize isn't just a way to get around an obstacle, but actually, I think, and this is my opinion, but I think history is on the side of innovations that are better, faster, and cheaper than what might have been the mainstream up until now. And this will, because it's better, faster, and cheaper, become the mainstream. And so what I see on our platform if you look back over the past 4 years, is a slow and steady migration of the innovation from the margins of the economy into the mainstream. Now, Reg CF is smaller of the crowdfund, of the bundle of regulations that when we talk about equity crowdfunding, we're talking about, a variety of different exemptions, and Reg CF is the smallest, even though the cap has come up to 5 million. But within that bundle, I've got on my platform an Italian soccer team that's coming to market in the next couple of months. I have mainstream, Fortune 500 companies who have been inquiring. And so I think online capital formation will, we can talk about what the time horizon will be, but I think it will increasingly be a significant part of capital formation. The 1.5 million individual purchasers that Woodie described, guys, 5 years ago, that was zero. It was zero. So that rate of growth is only going to continue. I predict it'll accelerate. I'd love to hear other people's thoughts, but I think not just in terms of being a solution to obstacles in the traditional capital markets, but being actually a better way to proceed with building relationships between customers and stakeholders. Reg CF and online capital formation will be a dominant portion of the capital markets.
Okay, so totally agree with that. Are you seeing mainly startups using this? Are you seeing, round doing this? Are you seeing, companies that want to do world domination? Or are you seeing very smaller firms across the board?
We specifically don't tend to be the best solution for, pure startups. Guys, I've got an idea. Let's get some capital in from the crowd. I'm going to make a product. I promise it's going to make everyone millions. We don't aim our offering at those types of entrepreneurs. I know, there's a thread going in our chat. I think Greta was asked, when should I do a listing on a portal as opposed to a standalone Invest Now site? Our business is in that standalone Invest Now site. So the brands that we work with have some sort of a community already. They have some sort of attraction that makes them confident that they will be able to attract capital. They have a newsletter list. They have an Instagram following. They have relationships with influencers, but they're not starting from scratch. So, we tend to work with brands who are a little bit more established, and we expect that'll continue to be the case. That's just where we sit in the market.
Okay, Etan, go ahead, Woody. What do you want to say?
I just want to add to that point that if you look at the data and you look at the pre-revenue companies versus the post-revenue companies, in the very beginning when the industry got started, the majority of companies were pre-revenue. But now when you look at companies that are coming online, the majority of them are post-revenue. So there's been this shift to more sophisticated companies that are using it. I think to your point, now that the cap's gone up, you see how more sophisticated companies see the opportunity here to raise money from their customers. And if we can push that cap even further, I'm a huge advocate for pushing this up to 20.
Absolutely.
I think we really see a lot of sort of mid-sized, larger corporations getting in here, and that 1.5 million to what we were just talking about, and Matt pointed out, will dramatically jump much.
Okay, higher. Etan, what are you seeing in the real world? You guys are have boomed recently.
Yeah, I think that we're seeing an increase in sophistication amongst issuers, certainly Reg A issuers. But at the same time, not every company has a community, right? Not everyone's fortunate to have a big base of fans, followers, subscribers, and customers and users that they could tap and give the opportunity to become investors. If they do, that's a tremendous advantage. And they should probably expect their investor acquisition cost to probably be lower than someone who has to go and create that audience from nothing. What I've seen is companies could use Reg CF to raise $100,000, $50,000. I mean, we work with CF issuers that are generally the 3 to 5 million that have plans for a follow-on Reg A, and oftentimes they'll do a CF with a D, right? So they'll use that capacity of the 5 million for the not yet accredited investors, and they'll kind of direct the accredited investors to the Reg D, which you could raise in unlimited amounts. That's a very common structure. but it spans the spectrum. I mean, we have, on the one hand, we have REITs, right? Boring vanilla REITs offering yield, and they're building communities, and they're setting up apps, and they're relying on marketing and promotion to build their own communities. Maybe they'll have an influencer involved. Maybe they'll hire a marketing company, or they'll have internal marketing. And so you don't need, and of our 240, just moving over to Reg A for a second, we have about 40 fractional share platforms. These are companies that aren't starting off with a list of anyone. They're building that kind of from scratch through PR and through advertising and marketing. They're looking at these exemptions as a business model, not as a one and done raise, right? You could launch a CF if you need to raise a few $100,000, and you're probably best suited to consider platforms like some of the marketplace platforms that are out there, right? And hope that you maybe get some momentum with a limited budget on those platforms. If you're looking to work with a company like Dalmore, and I know with DealMaker as well, these are companies that recognize the importance of marketing and promotion, and they want to position themselves to be the sole beneficiary of their marketing and promotional efforts. They want to position themselves to be the sole beneficiary of their conversion of their ecosystems from customers to investors, rather than send them to a marketplace where they could shop amongst many other potential opportunities. So it really depends on what stage the company is at. But ultimately, I look at these exemptions as a tool that allow for founders to offer whatever share class structure and valuation that they are comfortable with and that is reasonable to the masses, pretty much internationally, and they're free to market and promote that widely, and there's multiple ways to win. And a lot of what we talk about when issuers contact us is, how do you want to understand how to win before you start. This is not a you build it and they come type of a model. You don't just get qualified to raise up to 5 million in a CF or 75 on an A and launch and expect people to come flocking to you. You need to be very thoughtful. And there's multiple things included there. There's obviously conversion of your own ecosystem. There's marketing, right? Digital marketing, pay-per-click, Facebook, TikTok, etc. There's funnel management, right? What do you do when people come to your site, but they don't follow through with the investment? Technology needs to be utilized to bring them back into where they left off. There's IR, right? There's proactively reaching out to investors at various stages of the investment process. There's influencer networks. There's companies that have celebrity partners, and that has the natural and obvious benefit of widening the lens of people that recognize who you are and can relate and want to participate. Okay. And there's also syndication.
Right. And I'm going to come back to that point in a minute, but I want to go back to kind of the original question is what I'm hearing from you guys is it started as very early stage, perhaps pre-revenue startup stuff. The funding cap has been increased. Now we're seeing later stage, maybe seed A, maybe A round. Today a seed funding round can start at $4 million or even more. It just depends. So it kind of spans the spectrum. Etan, you mentioned REITs. Real estate issuers are also using CF2, and it appears you're seeing. There's at least one platform that only does Reg CF real estate offerings, which I think is kind of cool. But other people are using the exemption for real estate as well, correct? Anybody?
They are. There are definitely many real estate clients who are and issuers who are using Reg CF. Generally, though, what we see is REITs it's an ongoing proposition. It's not a one and done raise, right? There's not a limit to the amount of capital that they're looking to raise. So ultimately, they graduate to a Reg A. What we're seeing a lot are these platforms that are using Reg CF, offering equity to finance the build out of their platform. But the platform itself ends up being a Reg A, generally a series issuing Reg A, right? That allows them to raise a lot more.
And I'd also like to interject a quick point here. Both DealMaker and Dalmore, you guys both have broker dealers. And under the exemption, you can either use a funding portal, which is kind of like a broker dealer light, or a true broker dealer. And there's some benefits to going the broker dealer path. But I wanted to jump to now, because I think it's very important for issuers, is how much does it cost to actually pursue a CF offering? Because there's legal documents, potentially audits. You need to work with accountants and lawyers. Matt, what's a range of cost for a company to pursue a Reg CF offering online?
Okay, so there's offering costs, which are just mechanical, right? You have to file a Form C, you probably want a lawyer, you have to prepare a landing page, you have to process payments, usually by credit card, you have to have a transfer agent who's going to cut the share certificates. But I'm happy to answer the question, but I want to really kind of bring the conversation in response to your question, to two places. There's offering costs, the mechanics of just, processing investments online. And there's, what Etan was really talking about is, what does it take, guys? What does it really take to be successful? Because I can tell you how much it costs mechanically to issue shares online to people who buy them. But the conversation around, how you convert your community, how you engage with them, how you build leads, the IR, I think Etan gave a really nice list of kind of 5 key things. Like, that's where we see issuers who end up, spending a lot of money. Like all e-commerce, your budget for creating traffic on the internet varies hugely. Big brands don't have to spend as much on investor acquisition because they have a community. But if you're just starting out, or if you have, something that's going to be the next big thing but doesn't have a track record yet, you could spend significant amounts of money driving traffic to that site, creating interest, creating buzz, making video, using the internet and the techniques and tools of e-commerce to really create a funnel and convert, the maximum from that funnel. So let's just go back to, the mechanics of a deal. It could be like $20,000 all in to be due diligence by a broker dealer, set up on a platform or on a separate InvestNow site, and pay the fees to have an escrow provider, have a lawyer review the forms, and get ready to process payments. It could be $100,000 if you're adding marketing spend and top of funnel investor eyeball acquisition to the offering costs as a whole. So that's
okay. We're gonna get to that promotional stuff next. So we're talking 20 to 100 for a range.
I think Matt's right. I think there's, it varies, right? There's like 70 or so CF portals out there, most of whom are not doing much business. There's about to be, and there is right now, a consolidation that's been going on in the space. Most of the marketplace activity is like Woodie had mentioned, is kind of consolidated amongst very few, 3 or so or 4, CF platforms. And you see some of their structures where some of the CF portals are choosing to kind of absorb upfront cost or like charge the issuers out of first money in. It's a model that hasn't necessarily worked so well for them, but they're very eager to lower the barrier for some of these issuers that are looking to raise capital. I think, Dalmore and other firms that are out there, I know, we charge what it costs. I mean, there needs to be an attorney involved that prepares the subscription agreements, that files the Form C. There needs to be legitimate due diligence that goes into this, extensive due diligence. There's operations and compliance and support work that goes into the process. So I think that 20, 25, give or take, sometimes it's a little bit lower, sometimes a little higher, is probably what to expect. And then as far as marketing, if you have a big base and you feel confident that you could convert that base, then it's more about messaging the opportunity to them than it is spending money on ads. Most issuers don't have a significant base, so they have to hire a marketing company. And a lot of them ask us, who's working well with other clients of yours, right? Who's been doing for similar clients that fit our profile. So we'll usually introduce 3 or 4 marketing companies that we've seen deliver recently. And they charge monthly marketing fees, right? Like an advisory fee, and that could range from $7,500 to $20,000 a month. And then it's how much do you want to spend on marketing, right? And so you want to have a budget for marketing and stuff.
This is a big discussion, and I'm going to jump back to that in just a second. But I was going to ask Woody very quickly, what are the costs are you seeing? Do you have any insight into that?
Yes. So I got really irritated a year ago or so. The New York Times ran a story on crowdfunding, and they talked about how incredibly expensive it was. And I was like, what are they talking about? Like, what's your source? And so I contacted the person that wrote the piece, and they didn't have a source. And I was like, how can you put that in writing if you can't actually back it up? So
That's typical.
yeah, it's a reporter. They don't have to be accountable to anything. So I was just like, well, we got all the data. So I surveyed the top four. I went like through the past quarter at the time. I found the top 400 offerings, and I did a survey of them. And I said, please tell me, what you spent on legal, accounting, video, all the parts that you need to put together one of these offerings. Now, I'm not talking about the full, if they did a bunch of marketing like Etan was talking about, sure, that was included in there. But the average amount, and this doesn't include the fee that you're going to pay the platform for the money that is raised. This is like all the fees to get onto the platform. It was about 5.3% on average of the total amount that you are raising. So, I that put it in perspective. If you're raising $100,000, expect to spend about $5,300. If it's going to go up from there. But yeah, I mean, there are costs.
Okay, so I just want to interject one thing is, if you're working with an attorney, make certain you work with an attorney that has experience in this space, because if you go to big law and somebody who has never done this before, you will pay too much. I promise you. Work with somebody that has experience. Matt, I know you're going to agree with this. You have experience in stuff. You're an attorney. It's better to talk to somebody who knows what they're doing. So let's go back to promotion, because this is a key aspect. And I know that both DealMaker and Dalmore, you kind of are specialists in this space. So I'm going to jump over to you, Matt, because this is like a key functionality of the DealMaker service, right?
Yeah, so DealMaker is a group of companies. I mean, when you say DealMaker, Dalmore, we work together all the time. I think we have like 14 shared clients currently, and historically, a lot more. So the pieces in a crowdfunding offering, and this is just to be precise, a little bit kind of more so for Reg A than for Reg CF, because Reg CF, there can be a lot of issuers who are monetizing their own community. Like Etan said, could be, taking $100,000, $200,000. It's not necessarily issuers aiming for 20 million, 30 million, 40 million, like you see under Reg A. But the key pieces to having a successful offering, the first thing is preparation. Really understand, who your story is going to resonate with, have some sense of how to present that story, right? So that you can identify how you want to go after that target audience. If it is going to be by creating content online, you need a marketing firm. We own one. So we acquired a company called Ridge Growth, who was a specialist e-commerce marketing firm. We brought them in-house so that issuers on the DealMaker platform can get the benefit of our in-house marketing team. But like Etan said, there's many out there. It very much depends on what your story is, who your audience is. There are some firms who specialize in telling certain stories certain way to certain audiences. And I hesitate, I know some people are asking in the chat for, names. I hesitate to just say firm X or Y or Z or Z. When I'm in Canada, I go to Z. I hesitate to say that recommendation is, one kind of broad recommendation that can tell all types of stories. We've got companies on our platform who are selling drones. We've got companies on our platform who are cannabis oriented. We've got companies on our platform who are very early stage. We've got companies who are much more mature. And so you want to choose somebody who has a track record, same way you choose a lawyer, someone who has a track record in servicing the type of business that you identify most closely with, because they've done it before. They don't need to learn on your dime. You can get the benefit of expertise that other people have helped them develop.
Okay, Etan, so can you drill down on this a little bit? Are we doing Facebook ads? Are we doing YouTube? Are we doing TikTok? I know that email is key. I know that when you see an offering on a website, there's an ongoing discussion, there's engagement, which I think is absolutely vital. Somebody has to manage that. Sometimes some issuers will manage a portion of that themselves. Sometimes they outsource it. What do people have to do to raise the money?
It varies on what the nature of the company and the intended demographic that might have an interest. So a REIT offering that's offering a 7% yield, solution to investors is going to be different than a kind of a Web3 oriented or a gaming type of a CF offering that's going for a different demographic. Each marketing company is going to vary a bit as far as their approach. But generally, it will include all social media. It will include webinars. There's a whole kind of crescendo effect in the marketing efforts of these offerings, right? There's whether it's fear of missing out or whether it's messaging, I don't know. But oftentimes we'll see half of the capital raised for a CF occur, right in the beginning and right at the end, the last few days, right? So there's a whole story and funnel management process that goes into it, which is pretty interesting. But we're seeing it's testing, optimizing, and scaling, right? So you hire a marketing company, you have a certain strategy, you come up with the materials, and then you test different strategies to see which ones are converting better. Always keeping an eye on the return on advertising spend. So if you're seeing a 20-to-1 type of return on a certain type of advertising you're doing, you're going to pour the gas on that. Whereas if you're seeing things that aren't converting well, you're going to tap the brakes and you're going to assess why, right? So it is a process and it does change depending on the strategy.
Okay, so you have to be agile.
Can I add something? Because I think this is like one of the really interesting points that are driving the growth of the space. I asked permission to add and then I just started talking. So I'm going to add something. Unless you stop. In the world, there has been this division between a marketing budget where a company will go out and try to tell their story, identify their audience, spend money, TikTok, Facebook, social media, etc. on the one hand. And then they go and they try to raise capital on the other hand, and maybe they hire investment bankers and maybe they talk to friends and family. What we're seeing is a convergence of those worlds, right? Predicated on a very simple and very, very powerful insight. Raising capital is just sales. It's just sales, guys. It's, as Mike in the chat says, a founder who knows how to tell their own story. It's identifying the right type of buyer. It's making sure you engage with them in a way that's persuasive and delivers confidence. It's staying on top. It's running a funnel. It's getting to a closing. And so what the internet has done for sales of people who make shoes, the internet has done for sales of people who make securities. And fusing these worlds together is, I think, extremely powerful in driving online capital formation into the mainstream. Does that make sense?
Okay, so yeah, absolutely makes sense. So I want to jump over to, I need to keep this going because we don't have all day, even though I know we could all talk about this all day long. I'm going to talk about the types of securities, and then Woody, I'm going to ask you for the actual details, but I'm going to start with you, Etan. In the early days, we talked about equity crowdfunding. It's really not just equity crowdfunding because there are platforms that issue debt. People can do debt. They can do rev share. They can do preferred equity, which is a little bit different. And then there's safes. What are you seeing as the most common security being utilized via your services for Reg CF offering?
Common, right? Typically non-voting common. We're not seeing a lot of debt for CF. We're seeing it more on the Reg A side. Usually, Reg CF is used more on the startup side. With some safes, we're agnostic as far as structure. I know each platform, like marketplace platform, has their own kind of go-to strategy. Like Start Engine has one, WeFunder has one, Republic has one, but I would say the majority of the CFs that we're working with are common equity. Okay,
so that's interesting. Matt, you're an attorney. Can you explain what a safe is for our audience?
So if anyone who knows what convertible debt is, a safe is convertible debt without the debt. Same foundation, right? Back in the day, convertible debt arose to fulfill a need for a type of security when you couldn't exactly value what the company was, right? Traditional capital raising, priced round, my company's worth $2 million. I'm going to sell shares that reflect that valuation, right? Convertible debentures came along to say, I don't know what the valuation is. Either the product's not ready yet, or the FDA hasn't approved it, or the market conditions are wonky like we're seeing right now. And so I'm going to give you money, and that money will convert into equity at a price to be determined later. The SAFE is a type of security that came along and took that one step further, whereas convertible debt had an or else. I'm going to give you money that will convert at a price to be determined later, or else you owe me the money back. The SAFE just said, I know you want to buy shares, you want to be an equity owner, so you are going to convert into a price to be determined later, and there is no or else. It's just what's going to happen. The company will either raise money at a later date and continue to grow, and you will convert based on the terms of the later raise, or the company is going to die and your investment has gone to zero and I won't have any money to give back to you anyway. So the SAFE is a type of security that is designed for an investor to put money into a company at a price to be determined later based on a set of criteria. Most typically, the price is determined later based on the next funding round, and the investor who puts in money today with the SAFE will get a discount of some sorts to that next round. So I don't know what the company's worth today. Here's $100,000. It will convert into equity at a price that is a 25% discount to when you go out and get Bessemer to fund your Series A, right? That's what a SAFE.
Right. Okay. So yeah. So if people describe it as a very founder-friendly approach to raising capital, and it's true. It's almost like an option. A lot of very early stage companies fail. That's normal. It's typical. This helps these early firms that you believe in get to the next level. You know, on the other side, I guess there's preferred, which is more of what a VC would like to see. Woodie, what is the actual split? Because you know, what's the spread between all the security structures?
Let me pull up the data. So if I'm looking at the different security types, and I just look at them, the biggest ones, common stock, SAFE, preferred stock, about 28% of all offerings are common stock, 25% are SAFEs, 11% are debt, and about 10% is preferred. What's interesting, though, is even though that 9% is preferred stock, that's about, I would say, it's been $308 million, so it's about 18% of all the money that's been raised to date. Common stock has raised 27% of all the money that's been raised to date, and SAFEs have been 24%. So it's interesting, Andrew, that even though we hear SAFEs, people are using SAFEs. The reality is, and I would be strategic here if you're an entrepreneur looking at this, like, okay, so if the data shows that common stock is raising more money than a SAFE, and I'm sophisticated enough, and I want to bring on, some investors that are more sophisticated as well. I mean, like you just said, SAFEs are not very investor friendly. They're very founder friendly. So if you want to raise more money, I would probably go with convertible debt or a SAFE or preferred. I mean, everybody loves preferred. So stick with things that investors will get behind because they're familiar with it. I think a SAFE is great when you're really early stage. And obviously the data shows that companies are raising tons of money, but think about who your crowd is.
But Woody, didn't we say earlier that the majority of securities sold in this space are by the top 5 platforms, right? Like, aren't we, right? Isn't it also the case that one of the platform uses a SAFE and one of the platform uses preferred equity? So really what you're tracking there is the performance of those platforms.
Yeah, that's a good point because, there's definitely a platform that you only see SAFEs on. But other platforms that have a mix. Now, that one that only has SAFEs happens to do probably the most deals. But it's not always the case. I mean, that's limited to maybe one only SAFE platform. And then there's another one that's predominantly SAFEs, but I would say they've got a mix. And then the other two leaders, I think one of them.
I'm just saying, just like bear in mind as we think about founders kind of choosing the right instrument for their audience, sometimes that's not a choice. Like with DealMaker or with Dalmore, you get a choice. You choose what makes the most sense for you. Some platforms don't give you a choice. They just say, this is the security we sell.
Okay, so I want to keep things moving because I want to leave a little bit of time for Q&A, and we've got lots to cover still. You've raised the money. You've issued your common equity, your debt. What is the responsibility for the issuer post-funding round? Don't you have to keep in touch with your investors? Don't you have to file documents with the SEC under Reg CF, Etan?
Yeah. Well, there's obligations, and then there's kind of what's the right thing to do. I think the minimal obligation is submitting an annual report, Form CAR, right, to through Edgar no later than 120 days after the end of the company's fiscal year. But again, this is all about community. And while someone who's investing $500 shouldn't expect to have Friday coffee with the CEO, you want to engage these people. They're putting their hard-earned money into your business, and they deserve to be communicated with. And so you could communicate with them all kind of collectively through one outreach effort, right? But we encourage the more communication, the better. It's always a great thing to have, and you're going to go back to them for your future capital raises, right? You start off with the CF. If they have a good relationship with you, they see that you're updating them, whether it's good news or bad news. That's how you build a relationship with thousands of people on your cap table. It's really through consistent communication.
Matt, I think you'd echo what you
Absolutely.
just said.
Can I add, or do you want to keep going? I think, isn't the whole point to build and engage and fire up a community so that they tell their friends, so that they come back as customers, so that they feel connected, and so that they carry your brand in the market? Like, it would be a sin. It would be a sin to go to the trouble of bringing in a new shareholder and then just like move on to the next thing. So there's really compelling reasons to do it. I mean, leaving aside your filing obligations, which are your obligations regardless, I think if you go to the trouble to build a community, like, please go to the trouble to maintain that community.
Yeah, so I want to just kind of jump in there because, Etan, you mentioned this, that frequently this is like a first or second round, and you're going to do it again and again and again, just like venture capital. You do seed A plus, B, C, D. Sometimes they extend the rounds. And from my point of view, I see the online capital formation industry kind of like copying that or replicating it, but more effectively, more efficiently, and hopefully for a lower cost of the issuer. Are you seeing a lot of follow-on funding rounds, Etan, Matt?
Oh yeah, both of us are seeing it, with shared clients all the time. And and it goes to not just follow-on rounds. This is a business that you could, again, it's per year, right? You could use this every year. It's rolling 12. And what we're seeing is, like with both with CF and A issuers, with Reg A, you could increase your price per share by up to 20% without having to get the offering requalified. And if you want to go beyond that, you have to get it requalified. Or with the CF, you could take the offering down and increase the valuation as a material change, and then relaunch for the balance of what you're able to raise that year. So what you do is these issuers are breaking up their capital raising. They may, if they're looking to raise 5, they may raise the first 1.5 million at a certain valuation. Once they hit certain milestones that they could report, hey, we've grown our business, we've signed this contract, we've made this penetration, we've raised this capital, then they could increase the valuation appropriately, and then go back to those same investors and the general public with a pretty compelling opportunity, building on their growth. So yeah, absolutely, we're seeing that.
And I think especially in the early days, platforms didn't, push issuers to keep in touch with their shareholders. And I think you're seeing more of that today. And I think what you guys are doing now is you're focusing on the full stack of capital raising, and you have to keep in touch with your investors. And I think that all platforms, whether you're a broker dealer or your funding portal, you need to tell your issuers this. You need to keep in constant contact, send out emails, reach out to your shareholders, because they believe in you, and they'll stop believing in you if you don't let them know what's going on. We're quickly running out of time. I want to ask, one quick question of you guys. do you have any great like examples of a Reg CF issuer that did really well, Matt? That was just as kind of emblematic of what you want to accomplish?
Monogram Orthopedics, I think, is a brilliant company. I mean, I can give my personal opinion. We never endorse or, make recommendations of what people should buy, especially while deals are live. But I think, from my criteria of, companies who are telling a story that is articulate and sharp, that are engaging with the community to really have a two-way dialogue about, the future of the company and the direction of the products. Monogram Orthopedics is I think top of the charts.
Okay. Etan?
Yeah, Matt, one that we share.
Well, yeah,
Trust
yeah.
is, I think, a good example of a CF that worked with Dalmore as the broker dealer and kind of strategy, and we partnered with DealMaker on the platform technology, which we have done very frequently, and I hope we continue to. And that was a great example where two of us worked together with a really great issuer who oversubscribed a Reg CF 5 million. And then did a Reg A, and then raised the growth capital they need, and then listed on NASDAQ. I mean, what better story is there than that, right? So that's a great example. I think we're going to see more of those.
I do, and actually, we actually just wrote a short story today about an issuer that did a couple CF funding rounds, and then Reg A, and they listed on NASDAQ this week. And the early numbers that I have seen show a pretty nice exit for their early investors.
Oh, huge. Atlas. Yeah. I mean, great. And these are, and again, this is such a new industry, right? That we're just starting to see these success stories. And which is, I think we're going to see a lot more of those as the sophistication of the issuers increase.
Yeah, absolutely. And it does take time. Early stage investing is not for the impatient, because frequently, it takes time for companies to become established. If you're participating in a securities offering like this, you have to be willing to accept that fact up front.
Yeah.
So we're quickly running out of time. I want to get to a couple questions. I saw that somebody was asking about secondary liquidity.
Yeah.
That's actually a very good question. I will say this very quickly, and then I'm going to jump over to you guys, that you can, for Reg CF, you can effectively sell them to somebody else after a year. The ecosystem is not very good. There's a push to have the Securities and Exchange Commission improve that. I think in the current leadership, it's not going to happen. I think that Congress may act to pursue that. Etan, you actually provide some secondary liquidity. Do you want to talk about your perspective on that?
Yeah, like you said, CF, you have to wait a year to season your shares before you could access secondary market trading, and I wouldn't expect it anytime soon going into an investment. Where we're seeing the majority of secondary market trading is really with Reg A, which has an immediate path to potential liquidity. Doesn't mean there's going to be like, it's not like you're listed on NASDAQ or New York Stock Exchange where there's a whole liquid marketplace. It's still very early days. So the majority of the secondary trading we're seeing are with fractional shares of real estate collectibles, art, things that are broken out into like $10 shares. People are building portfolios of different assets or NFTs or racehorses and the like. And then the issuer has an app. They're constantly IPOing assets, and then they're facilitating secondary market trading of those assets right on their own app. And we're seeing secondary market trading with like really brand name established companies pre-IPO, right? So it's kind of like that extreme at this point. Whereas the average company that's doing a CF or an A to raise $5 to $50 million, we're not seeing a whole lot of secondary market trading at this point.
Woody, you have to have an opinion on this.
I mean, investment crowdfunding started in 2016. It took 3 years for traction really to start building. Now we're sort of at this tipping point where there's a lot more demand for capital. Secondary markets, it's 3 to 5 years behind us. So we're still in this nascent stage right here where people are just getting started. But I think, you have to hold it for 12 months, just like we just said. With Reg A, you can essentially sell them the next day. But I still think we're a couple years away from, seeing secondary markets and the true potential that they have.
Yeah.
Did we lose Andrew?
One of us is frozen.
There.
Yeah, can you hear me?
Yeah.
Now we can.
Back? Here I am.
There you
Yeah. Hear me?
Yep.
Yes.
Yeah. Sorry about that. I lost my connection for a moment. Matt, did you have anything you wanted to add about secondary transactions?
We don't, I mean, our technology supports the primary issuance of securities, so we don't deal with secondaries. I think it's very interesting. I think if we want to spend a few minutes taking the conversation that direction, I think I'm happy to share my thoughts on, like, there's two kind of big pieces to a market where people are buying and selling shares of a private company not listed on a stock exchange. There's the regulatory piece, right? What are the rules in a Reg CF? It's still a private placement, guys. There's still a hold period. So I don't think people should be under the misunderstanding that if I buy a share in a Reg CF, and I can sell it when I think the company.
We lose that.
Am I still here?
No, you're there.
Now you're back.
In the webinar, it's not like if you buy a share of a Reg CF, it's like buying through your brokerage a publicly traded stock and you can sell it at any time. There are still rules. There's a hold period. It's a private placement. So I do think that's an important part of the conversation. The second part is not regulatory dynamics, but market dynamics. If a company is private, it's not being listed on a stock exchange, how that market develops for the shares amongst private buyers and sellers, like, it is early days in that, right? I just don't think the data has really emerged. Woodie, you're probably closer to it. I mean, you are closer to it than me. Etan, you too. But I think it would take a very special set of circumstances for a robust market to develop in private company secondary trading after a hold period of a year. And you'd really need to have been active as an issuer in continuing to tell the story, in feeding information to the community, because unlike a publicly listed stock, there's just no information out there. So how does a buyer know what price to bid?
Yeah, and there's a lot of solutions being worked on, by the way, and a lot of technology and platforms that are emerging behind the scenes that are really setting up for this. And there's probably no one out there more well positioned and helpful than Woodie in the space. I call him like Noah, preaching about the upcoming flood, because everyone's going to realize when for the whole industry, when they are prepared for secondary, they're going to realize that there's a regulatory and a blue sky component to it. It's very easy to overlook, but not one that's a lot of fun to if you get caught. So issuers out there who are considering secondary, Woodie's a really good resource, certainly on the regulatory side to prepare for that.
Thank you so much.
Yeah, I'll just add very quickly is that Reg A, you can actually trade the securities immediately. There's some hurdles there. Woodie's company is actually tackling that guard. We don't have time to get into that. There was a recommendation to the Securities and Exchange Commission to improve upon that under Reg A plus, and some people want to see it under Reg CF. Don't hold your breath. It's not going to happen in this current leadership environment, maybe in a few years. But I think that would be a good move for everybody, because also there's the investor protection aspect where, a security that can be sold has value, because maybe life changes, you need to move on. And I think everybody would like to see that happen. A couple of the quick questions I wanted to ask very quickly. Somebody asked about SCORE. And I don't know if you guys have done any SCORE programs. I actually know one platform that I think has focused on that a little bit. Does anybody know anything about that? It's a US thing, Woodie?
I mean, I know what SCORE is. I don't know how the platforms, if any of the platforms are integrating that in with their offerings.
Yeah, I haven't really, there's only one, and I think it was also maybe doing it on a state level. So I haven't seen a lot of that. Somebody also asked a question about the LNG industry, renewables. There are some platforms that are focusing on that. There have been some offerings. Does anybody have any insight on that?
I mean, the one thing I would just say is I am shocked and amazed at the technology issuers that are coming in this space and are using like the new infrastructure bill that just was signed as a target for, we've got our technology, we've got contracts with the government, and we think, with this new infrastructure bill, we're really going to take off. So, I know I haven't seen necessarily a platform per se that's focused on these, but I've seen these offerings on multiple platforms.
Okay, awesome. We've gone beyond time, so I'm going to just go around the room very quickly and ask for any parting words of wisdom. I'm going to start with you, Matt.
Well, I think this is a very exciting time and a very exciting space, and our message to entrepreneurs who are interested in online capital formation is always the same. We start with, we say, believe in yourself. If you can build a community to buy your product, you can build a community to buy your shares, and believe in yourself. Tell your story online. Don't be shy. Shout it from the rooftops, and happy to explore online capital formation with the DealMaker Group.
Awesome. Etan?
I would say that, for issuers out there that are considering launching an offering from their own website or app, it's very important to understand, how to position yourself to win before you start, and to understand all the tools that are at your disposal. That's something that we're pretty obsessed with, having observed all these offerings and are happy to share with you. And grateful to be on this webinar with all of you, and we really appreciate and enjoy working with each of you. And if anyone needs any issuers out there who want to get in touch, it's pretty easy to find us today. We look forward to speaking with you and being helpful.
Thank you. Woodie?
I am determined to solve the nut on how we get institutional capital into this space at a scale that makes a fundamental shift to the impact that this legislation has already had. I think we're going to be able to do that through AI-driven funds. I think we're going to be able to do it through incredible platforms like we've seen on this webinar. And I think we will have much more media coverage of it, where this becomes just a natural part of even the morning show, where they're talking about the local company that's getting funded. So this is a great time to get involved. If you're thinking about this, don't think, do, and get ready for, I think, what's going to be, just something much bigger than it already is down the road.
Yeah, I 100% agree with you. And I think that is part of the future of online capital formation. Reg CF, Reg A+, Reg D 506C, whatever you want to call it, the full stack. And I think it's going to happen. So I want to talk to you some more about this, because you look at Atlas, right? They actually raised institutional money alongside the CF and the A+, funding rounds. That's really cool, because they brought in the smaller investors early, but they were also, doing a D, and I think they took some other just direct investment, and that was effective for them. And what I also like to see is same terms, but that's a longer conversation. And I think Congress should be working on finding a way to do that, to have the smallest investors gain access to the very best security offerings. That should be the goal. So on that note, I want to thank you guys, Dalmore, Matt, who was just recently noted as the third fastest growing company in Canada, even though you have offices in the US and South America. And Etan, I've heard so many positive things recently about what you guys are doing. Both you guys are killing it right now. So it's very impressive. And of course, Woodie, my longtime friend Woodie, who helped to make this entire industry happen. It's awesome to get you guys together. Thank you very much, everybody who attended this. There is a document that I think has our contact information. Reach out to us. Let us know, what information you thought was helpful, what wasn't. And we will be returning next month. And I think we're doing Reg A Plus next month.
That's
so
right.
We will be back soon. So thank you very much, everybody. Have a great day. We will be emailing out a copy of this so you can watch it later. Thank you.
Thanks so much.
Thanks, guys.